So, welcome back everyone to the class accounting of share capital. So, let us now try to understand the types of share capital of the company. Broadly speaking, the share capital of the company can be divided into two parts: preference share capital and equity share capital. But what is preference share capital and what is equity share capital? In order to understand the difference between the preference share capital and equity share capital, we need to understand the following points. Preference, those who purchase preference share capital are termed as preference shareholders. So in case of preference share capital, the preference shareholders have a preferential right to receive a fixed rate of dividend. That means whenever a company issues preference share capital, they are always guaranteed a certain fixed rate of dividend to the preference shareholders. For example, a company issued 9% preference shares. That indicates the preference shareholders will receive a fixed 9% dividend every year from the company. Whether irrespective of whether the company earns profit or loss, the preference shareholders receive their fixed rate of dividend every year. Moreover, the preference shareholders also have the right to repayment of capital at the time of winding up of the company before that of equity share capital. In case a company is running in loss and winds up and decided to wind up its business, in that case, the preference shareholders will be first paid back their capital, and then if something remains, the equity shareholders will be paid back. So, why anyone should go for equity share capital? Equity shareholders did not have any preferential right like the preference shareholders to receive the fixed rate of dividend every year. Moreover, the equity shareholders also, at the time of winding up of money, the equity shareholders also did not receive repayment of his capital before the preference shareholders. After the repayment of capital to the preference shareholders, if the company does have any portion of money in their hand or in their bank account, they will repay the capital of the equity shareholders. But still, people will purchase equity shareholders because, as we know, higher the risk, higher the return. In case of preference shareholders, the rate of dividend is fixed, whether irrespective of the fact the amount of profit earned by the company. If the company earns loss, then also the preference shareholders will get a dividend at a fixed rate, but equity shareholders does not receive anything. But in case the company started earning heavily, and in that case, the equity shareholders will receive a huge amount of dividend in that year. So, whenever the profit of the company increases, the dividend of the equity shareholders will going to increase, and but the dividend of the preference shareholders will remain fixed at a certain rate. So, as the profit of the company increases, the dividend of the equity shareholders will also increases. So, the equity shareholders take higher risk and they are getting higher return. So now let us understand the two difference between the preference shareholders. This is the two key difference and the equity share capital. Number one, preference shareholders have preferential right to receive a fixed rate of dividend. Equity shareholders do not have any preferential right to receive dividend and repayment of capital at the winding up of the company. Number two, preference shareholders have the right to receive repayment of capital on the winding up of the company before the equity shareholders. If the company earns higher profit, then the equity shareholders receives a higher amount of dividend, as I told earlier, which means higher the risk, the higher the reward. Classification of share capital. Share capital can be classified into many parts. These are as follows. Number A, authorized capital. Authorized capital is the maximum amount of share capital authorized by the memorandum of association that a company can raise. That means the authorized share capital is the maximum amount of share capital that a company can issue, that a company are authorized by, to issue to the public in general by their memorandum of association. A company cannot issue more shares than its authorized share capital. Issued share capital. Issued share capital is the amount of share capital that is issued to the public for subscription. It can't exceed the authorized capital. So issued share capital means that amount of share capital that a company actually issued in the market to the public. It can be equal to the it can be less than the authorized share capital. It can also be equal to the authorized share capital, but cannot exceed the authorized share capital. Subscribed share capital. Subscribed share capital is the amount of capital that has been subscribed by the members of the company. So subscribed share capital is the amount of share capital that is actually being purchased by the people at large from the share market. So let us understand it with the help of an example. ABC Limited has an authorized share capital of 6 lakh shares of face value of rupees 10 each. So that means ABC Limited. That means the memorandum of association of ABC Limited authorized it to issue maximum of 6 lakh shares at the face value of rupees 10 each. The company has issued 4 lakh shares at the rate rupees 10 each. That means the company ABC Limited has actually issued 4 lakh shares out of 6 lakh authorized shares at the rate rupees 10 each in the market, and it is the issued share capital. But suppose that the company manages to sell 3,50,000 shares. That means the company issued 4 lakh shares to the public, but the public purchases only 3,50,000 shares at the rate rupees 10 each, and the company gets the full amount from the subscriber. So no amount is due. That means in that case the company's subscribed and fully paid up share capital will be 3,50,000 shares into rupees 10. That means rupees 35 lakhs. But suppose that the company manages let us assume another example situation. In this situation, the company manages to sell 3,50,000 shares as in the previous case at the rate rupees 10 each, but manages to get only rupees 8 from the subscriber. Rupees 2 is still due. Then the company's subscribed but not fully paid up share capital will be 3,50,000 shares into rupees 8, that is rupees 28 lakhs, and that is rupees 8 out of rupees 10. That is rupees 8 out of rupees 10 will be its subscribed but not fully paid up share capital. Similarly, suppose that the company manages to sell 3,50,000 shares and calls rupees 8 out of rupees 10 and receive the full amount of rupees 8 from the subscriber. That means the company issued 3,50,000 shares in the market. That means a company issued 4 lakh shares in the market, and the people purchased 3,50,000 shares, and the company calls rupees 8 out of rupees 10. Rupees 2 is still not called by the company, and the company receives the full amount of rupees 8 from its subscriber. Then the company subscribed but not fully paid up share capital will be rupees 3,50,000 into 8, that is rupees 28 lakhs, or rupees 8 out of rupees 8. Similarly, the company manages to sell, suppose that the company manages to sell 3,50,000 shares and called rupees 8 out of rupees 10, but received rupees 6 from the subscriber. That means a company issued 4 lakh shares in the market, people purchased 3,50,000 shares, and the company calls rupees 8 out of rupees 10. Rupees 2 is still not called by the company, and the subscriber paid rupees 6 and rupees per share, and rupees 2 per share is still due. Then the company is subscribed but not fully paid up share capital will be 3,50,000 into 6, that is 21 lakh, that is rupees 6 out of rupees 10, rupees 6 out of rupees 8. So from that point of view, the subscribed capital can also be further divided into two parts. Number one, subscribed and fully paid up. That means if the company issued 4 lakh shares and the people purchased 3,50,000 shares, and the face value of each share is rupees 10, and the subscriber paid full amount to the company, then in that case the subscribed and fully paid up share capital will be 3,50,000 into rupees 10 as described earlier from the example. Subscribed but not fully paid up share capital. Subscribed but not fully paid up share capital is the amount of capital that the company has called up in its total face value of shares but not received it. That means a company issued 4 lakh shares, people purchased out of rupees 10 each face value, people purchased 3,50,000 shares and the company received rupees 8 out of rupees 10 from its subscriber. Then in that case its subscribed but not fully paid up share capital will be 8 out of 10, rupees 8 out of 10. Similarly, if the company does not call the final rupees 2 amount out of rupees 10 face value, then its subscribed fully paid up subscribed but not fully paid up capital will be rupees 8 out of 10, as we see earlier in the example in this below example. So always bear in mind one thing, that in case of subscribed but not fully paid up share capital, it will be that amount of share capital which the company has already collected from its subscriber. So if the company collects rupees 8 out of rupees 10 face value of its share from its subscriber, then the subscribed share capital will be subscribed but not fully paid up share capital will be rupees 8 out of 10. And if the company manages to collect rupees 6 from its subscriber, then the subscribed but not fully paid up share capital will be rupees 6 out of rupees 10. It is very simple.